Good morning, Tradelo members, and welcome to the rundown for today. Another quiet session in Europe. Obviously, we've got that roll going through the indices in the DAX and the Eurostoxx. So what that means is there's just not much focus on the technicals at the moment. It's very much just about getting that open interest into the June month. We have seen most of the roll now in the US equities. They're pretty much trading the front month. So what that means is we can start to technically look at trading, the NASDAQ, the Dow, the Russell, and the S&P. But again, let that roll get through. It's one of those things where roll week is just one of those things you have to accept. And traditionally, what we do as professional traders is when the roll is happening, we tend to steer clear a little bit of the markets. Why? Well, because the price action tends to be very, very misleading. You get very one-directional moves come out of nowhere, and it does make managing risk quite difficult. So just typically in these sorts of conditions, when we're in the roll, you want to kind of scale back that position. Don't overcommit. Get that roll through, and then next week come in and everything should be back to normal. Now, with that in mind, something interesting has happened over the last 3 sessions, and in particular, something interesting happened in the commodity space yesterday. Now, for the last 3 sessions, if you've been watching the bonds in particular, we are pretty much, we've seen a 13 basis points move in the US 10-year. Okay, it hasn't felt like that necessarily, but the bonds are steadily just grinding lower. Now, again, it started obviously pre-CPI, so Monday we started to see that sell-off. It continued after the US CPI that came in marginally higher than expected. And again, yesterday we had a continuation of that sell in the bonds. Now, very, very important. Keep an eye on that, okay? Obviously, there's not much volatility in the bonds, but yields are steadily rising. Like I said, from the start of the week, we're up 13 basis points. Now, that's not a small move, and what does it mean for the broader markets? Well, nothing really. Like I said, it's not the absolute value of yields that matters. It's more the way in which it does, the volatility behind what creates that move. So for now, bonds are just steadily grinding low. I think stick with that trend. It does feel like something is developing perhaps in the bond market. And I think a reason for it is a combination of factors. One, yes, hotter than expected CPI. Yesterday I mentioned to you what we're starting to see is a little bit of a narrative form around this idea that the Fed may not actually cut 3 times, and they may only begin the cutting process after the fall. So think the last sort of 3 to 4 months of the year. They may only begin the cutting process then, or they may start in June and then wait a couple of months, perhaps 2-3 months, or 2-3 meetings, and then cut perhaps a second time in December or early next year. So we're starting to see that narrative form now, this idea of cut and pause. And I think that's also another combination, or that in combination with a higher CPI is leading particularly long bonds to offer. And then the third thing, and I think this is quite key as to how we move forward, is commodities. Okay, if you have a look at both the copper, to a lesser extent copper, but to more extent, have a look at what silver did yesterday. Okay, there was some big moves in some of the commodity space yesterday. Now, it's early doors, okay? Get a copper chart up and, you could arguably say, well, copper's in the same sideways range it's been for the last 12 months, which is true. Okay, copper hasn't broken out. It's not sort of glaringly obvious that everyone's bullish copper, but there are some telltale signs that, commodities are starting to heat up. We are starting to see a little bit of a bid come back into commodities. Now, again, like I said, take what I'm saying with a pinch of salt. It's very, very early days, but we want to be switched on for these things, because if today we see again another, strong bid up in copper, another strong bid up in silver, and perhaps even a nice decent rally in oil, okay, we're going to see that sort of rally in commodities start to fuel this idea that maybe inflation's about to tick higher, and as a result of that, long bonds are going to continue to offer as they have been doing since the start of this week. Okay, so that's kind of what I'm leaning on in terms of a narrative, is what are the implications should we see higher commodity prices on inflation expectations moving forward. Okay, now that in mind, like I said, oil, okay, very much in focus today. That's the chart I've posted for you. What I've said there is oil ready to break out? Now, we have been in the same $2.50 range for the last 5 weeks. Okay, this is a market that really lacks volatility. Every time it's approached, this $80.50 a barrel price, what we've seen is a little bit of interest, and then it fizzles out and it rolls over. Okay, so there's not really been commitment to hold on to these higher prices. No one's really too interested to be buying through 80.5s. Is today any different? Okay, maybe not. Okay, maybe we do the same thing. Maybe we roll over again, and maybe we stay in this $2.50 range until further notice. The point is, our job as traders is to be prepared for when that moment comes. Okay, so be switched on today. Oil is very much the market in play today. And what's created this sort of interest and intrigue in trading oil again today? Well, if you look at the numbers yesterday, obviously the oil inventory number continues to move in the direction of supply becoming tighter. Okay, if you look at the current 4-week average, we're only moving at around 1.8 million barrels. So we're starting to see, and again, I'm saying that's coming from almost 5-6 million barrels just 2-3 weeks ago. Okay, so we're seeing a real sort of significant move lower in the 4-week average of oil inventory. Now, again, that in its own is not a catalyst necessarily to be long oil, because obviously oil inventories move cyclically. They move based on the different seasons of the year. However, when we combine that with the fact that oil has been in backwardation now already for the last 3-4 weeks, again, the combination of those two do set up oil fundamentally for perhaps a decent breakout. So keep a very close eye on that. Fundamentally, oil looks like it could now push back into that $80 to $90 range that we've sort of sat outside of since pretty much Q4 last year. So keep an eye. Should we push back above this 80.50 today? Should we close above 80.50 on the dailies? That really does open oil up to the upside for a decent rally in the coming sessions. Now, what do we want to see? And this is key. Like I said, there's a lack of commitment. No one's really that interested in buying oil. So what we want to see, first and foremost, is we need to see a bit of volume. Okay, we need to see, someone step in today, take some initiative, bid that oil up. Equally, what we need to see is we don't want to see anyone providing liquidity. Okay, if you've seen the last 2 breakouts over the last 3 weeks, you would have noticed someone sitting there actually selling oil, quite comfortable, in offering oil. But what we want to see today is a sustained break, something where the market goes bid, stays bid all afternoon. We get that? Well, then oil is, yes, very much in breakout territory. And like I said, should trade its way back up towards $90 a barrel. Okay, implications thereof. Well, like I said, if you look at the CPI that we got out earlier this week, one of the key components was we're seeing gasoline prices tick higher. Oil goes up, that is going to create another headache and concern for the Fed. And keep in mind, we have got that Fed meeting next week, Wednesday. Okay, that being said, make sure you sign up for that Fed meeting. Everyone obviously is welcome, and I will post the recording obviously in the Discord channel for you. Otherwise, good luck today. Remember, manage that risk, manage those expectations. That's the key to roll week. Make sure you just step back, take it a little bit easier during this week, let the roll get out of the way, and then next week, get back on with a job. All right, good luck.